Welcome back, everyone, to another episode of the Mortgage Guru podcast. This one is for the week ending July 29th, and what a week it has been for financial markets, particularly for the mortgage world and the real estate space. So let's jump right in to some of the most important events of the week. Starting on Wednesday, we had the FOMC rate policy decision where they have raised the Fed funds rate for the second month in a row by 75 basis points, which is 0.75%, 0.75. This was mostly priced in. I think the market pretty much knew it was coming, but still this is interesting in that I think it allows an opportunity to discuss what the Fed funds rate actually is and ultimately what kind of impact the Fed funds has on the overall marketplace, but specifically mortgage rates. So the Fed funds rate is an overnight lending rate. It really doesn't have a direct correlation or impact to most consumers. It can for those that are doing more short-term type of financing, credit card debts, or things that are tied to shorter indexes like the prime rate. But generally, when we're thinking about consumer credit, and at least in this conversation on this podcast, we're thinking about mortgage rates, it really has nothing to do with mortgage rates directly. And this is shockingly one of those things that most people don't realize. And hey, that's why we're doing this. This is why the podcast exists, to shed light on some of these topics, these themes that are critical to understand. So here's the deal. The Fed has a dual mandate to maintain price stability and maximum or full employment. We could certainly debate over whether or not we're at full employment. I mean, the unemployment rate is near record lows. There are other data points that get stripped out of that, or maybe aren't fully considered when you think about the unemployment rate, like labor force participation, meaning the number of people who more or less are in the labor force, which means those who have given up no longer actually count towards the employment number. But with that in mind, we are at relatively record lows or very low levels on unemployment. So at least they can consider taking credit for maximum employment. On the price stability side, not so much. We are experiencing quite the impact from inflation this year. Many would say that's not much of a shocker considering all the stimulus quantitative easing that the Federal Reserve had done. But in another podcast, I'll discuss quantitative easing in more detail and what it ultimately means. It's not money printing in the sense that most people think. It's actually the Fed creating bank reserves by buying collateral from the marketplace, collateral being mortgage-backed securities and U.S. Treasury bonds. That is one way that the Fed can actually directly influence mortgage rates, which, like I said, I don't think we'll dive too deep into that on this one. There's enough other things to talk about. So backing up here a minute, the Fed has this dual mandate. They are in charge of maximum employment and price stability. All year we've been dealing with inflation. The Fed takes the blame for that. I think it's more the government and the government issuing too many stimmies, too many direct cash in hand type of stimulus offers, whether it's the $600 and $1,200 checks that were going out over the last couple of years, moratoriums on foreclosures and rents, allowing people to build up savings. In addition, you had these PPP loans, which ultimately were forgiven. That's a real cash injection into the economy. Whatever the catalyst you think is responsible for the jump in inflation, the bottom line is we are experiencing a 40-year high in inflation data. And the last CPI print, the Consumer Price Index, which is an inflation, a measurement of inflation, that came in for the June data. We get the data obviously lagging, but looking backwards in June, It was above 9%. So it's the highest inflation rate in 41 years to be exact. And that's caused a lot of issues in the market. It's caused a lot of issues for consumers. Some of that, again, there's all these debates and arguments that can be made as to why we're experiencing that. Some of it is supply chain issues that we're still kind of working out post the 2020 COVID ordeal. And there's things in economics like the bullwhip effect, and it's this supply chain rebalancing process where, supplies go up, supplies go down. There's a shortage of things, and businesses and manufacturers buy more and make more to try to fulfill the demand that's there when there's a shortage. Then they get too much inventory, and then they're sitting on too much inventory and they cut prices. And so you have this kind of up and down thing that's going on. But ultimately, supply does feed into that inflation measurement and causes some of the year-over-year spikes in inflation that we're experiencing. And if the Fed is tasked with regulating that, whether it's a fair expectation or not, they certainly haven't met those expectations. And so what they're trying to do now is bring down that rate of change of inflation. And really the only major tool that they have to do that, which is a relatively blunt tool to use with something that's such a hyper complex problem, is to raise this overnight lending rate. And so that's what they're doing, at least from an optical or narrative standpoint. That's their way of attacking this inflation problem. But the market's smarter than that. They've responded to inflation before, the Fed even accepted that it was an issue. The term of transitory inflation was still being used in the first quarter of this year. Markets knew better to get ahead of inflation. They sold out of the bond market. They pretty much sold everything. You've had one of those very rare years where stocks and bonds are both down. Risk assets such as crypto and things that are more momentum driven like tech are really, really down. So it's been a double whammy for markets. And a lot of that is the need for liquidity in an environment like this, where the economy is contracting, credit's more expensive, everything's more expensive because of inflation. You want to have cash, you want to have liquidity to kind of navigate that environment. But in the case of bonds, it's a big issue if you believe that inflation is going to be persistent, because inflation ultimately erodes the principal value of that bond. You have the benefit of cash flow by owning that bond, but if your actual principal that you've invested is losing value over time because of inflation, net, that doesn't usually balance out. So inflation is not very bond friendly, or bonds are not a big fan of inflation. And as a result, all year we've seen major selling in the bond market as investors were basically getting ahead of this inflation problem. So when we look at what has gone on as far as interest rates, specifically mortgage interest rates, the rate of change in rates is the fastest on record. Interest rates in less than 6 months basically doubled. That's caused the lowest home affordability in history, in certain indexes that measure that. Consumer sentiment is at an all-time low. And so as a result of that, there's, concerns about the ripple effects that this has throughout the economy, which we're seeing in the GDP numbers, which we're going to get to here in a moment. So bond investors get ahead of this. They sell bonds because they don't want exposure to this incoming inflation problem. The yield on a bond is inverse the price. So as more investors are selling bonds, the price goes down. It's a bit of a law supply and demand dynamic. So as that bond price is going down, the yield is going up. And that's ultimately what drives interest rates in most of the credit market is the way that bonds are trading and priced. This is especially true for mortgage rates. And a lot of people don't understand this. So when the Fed is raising its overnight lending rate, it really has very little to do with mortgage rates. What's driving mortgage rates is the buying and selling of these mortgage bonds. And they've been taking a hit just like every other bond as a result of this inflation problem. So mortgage bonds have been selling off. That means the price of mortgage bonds has been going down. And as a result, interest rates on mortgages are going higher. Now, here's a bit of a spin on this, or attempt to try to look at this differently with me, because there is a data set that gets put out by the central banks. There's a website that you can play with a lot of these data sets and look at the charts, but there's a Freddie Mac average 30-year fixed mortgage rate. This is a very, unfortunately, people reference this. I'm not sure if they understand it's not real-time data, and the whole idea of it being an average, I think, doesn't really serve much value. And one of the reasons for that is, like a lot of these data sets, it's somewhat backward looking, but the main reason is because, remember, mortgage rates, for the most part, are derived from mortgage bonds, which are issued as part of mortgage-backed securities. So you have a bunch of mortgage loans that are very similar. They get packaged into a bundle at similar terms, rates, all those types of things that you can imagine that have similarities, and they get bundled into a security called a mortgage-backed security that is sold in the secondary market or the open market. And when investors put money into that security, so they're investing into a bundle of mortgages, which in theory spreads their risk across multiple assets and borrowers instead of just one. And what they get in return is a bond, and that bond is paying them a fixed yield every month. And the way that the mortgages get bundled into those different bond coupons, and by bond coupons, I mean different interest rates, and for the most part in the mortgage-backed security world, those bonds are moving in 0.5% increments. So if you have a 5% mortgage bond, for the most part, you're going to have mortgage interest rates of around 5.25% to 5.75% that go into that security, or that are part of, the interest income from mortgages with those rates are paying that 5% coupon to the investor. Now, with that in mind, realize that when investors, for whatever reason, are no longer comfortable with, in this example, say, taking 5%, they're going to sell that 5% bond. And the price of that bond is going to go down, which means in order for a homeowner or a borrower to get an interest rate on their mortgage between 5.25% and 5.75%, which is the range of interest rates that would typically go into that type of security at 5%, the cost for them to get that loan is going up, because the premium that investors are willing to pay for 5% is no longer there. They're no longer interested in only getting 5%, and more of their money starts to flow into higher bond coupons, 5.5%, 6%, 6.5%, and the same rule applies there. If you have a 6% mortgage security or a mortgage bond, that means the mortgage rates or the loans in that security are going to have interest rates of roughly 6.25% to 6.75%. Some of this is an oversimplification, but clearly this isn't a simple concept anyway, so just bear with me here. So investors want more interest because they're concerned of inflation and all these other factors that we're kind of talking about, and as a result, they're selling or no longer buying these lower coupon mortgage bonds. And if they are buying at all, they're buying the higher interest coupons, which means those lower interest rates become more expensive. And a lot of people are familiar with the term paying points. Well, in the industry, what they're actually really called is a discount fee. And what I'm trying to describe to you, which is tough to do just in audio format, is you are ultimately incentivizing the market when you're paying those fees, those points, if they're specifically for a lower rate. When you do a mortgage transaction or buy a house, you have all kinds of closing costs, and people kind of mix them all together and say 2 points, 3 points, 1 point. But are you paying a point for the rate, or are we talking about the total closing costs in aggregate? So in this conversation, I'm talking about discount fees, which you pay to get a lower interest rate. And as part of that, what you're ultimately doing is incentivizing the market, who, in the examples I'm using, doesn't want 5%. They want higher interest. But if you're willing to pay them a premium up front, the way that they calculate it, assuming that the duration of that mortgage is maybe 3 to 5 to 7 years, which no 30-year fixed mortgage really lasts through duration. So based on history and the data, you're probably going to refi or sell or do something in at least 5 years. So for them, they calculate, okay, this potential loss of principal if inflation keeps up, the loss of interest if they take the lower bond coupon versus the higher, but they're getting cash or a cash premium up front to take that lower interest. So the picture I'm trying to paint for you here, it's a little tricky and complicated. I get that. Number one is the Fed raising an overnight lending rate has nothing to do with any of this, but this mortgage bond dynamic is what drives mortgage rates. The other thing I want you to try to visualize here is that forget 30-year fixed mortgage rate averages and data sets that, share that. Some of that's just survey related. So they're talking to lenders and saying, hey, what's your interest rate or what's your average interest rate? But even then that's misguided, because there is no just static, this is what 30-year fixed rates are, or here's your rate of the day. Because one way of considering this or looking at it is it doesn't matter what rate you're talking about, it exists, or ultimately it's available in theory. So whatever rate you want, you can get. So to ask a lender, a bank, a loan officer, a mortgage broker, a mortgage banker, say, hey, what are your rates? Or what is your rate? It's a really meaningless question. It's like asking, how much does a bag of groceries weigh? There's not a real clear way to answer that for anybody. Not only just because we don't know the borrower's situation, like credit score, loan amount, etc., but also because there's all these other variables, mortgage bond coupons, the actual interest rates that go into those coupons, and how those coupons are trading. So my point being, in regard to that, there is not like, this is what interest rates are, or this is the 30-year fixed average, is because at any point, mortgage rates aren't actually going up or down. And I'm going to repeat that because it's really important when you understand the market dynamics that drive mortgage rates. Mortgage rates aren't necessarily going up or down. What is really happening is the price you pay for a particular interest rate is either getting more or less expensive. So again, think about a 5% mortgage coupon. The mortgage rates that go into that are roughly 5.25 up to 5.75, give or take. And the more investors that are piling into that 5% coupon, the more expensive it becomes, which means the more money that's chasing it, the more liquidity that's there. There's pricing premium, as we kind of refer to it. And what that eventually gets to do is it trickles down to the borrower and makes that 5.25 to 5.75 less expensive. Because now, instead of the borrower paying fees or points to the investor and the mortgage company, now it's the opposite of that. There's a lot of money and capital fighting for that 5% yield, and that eventually trickles down and passes through to the borrower. And now the market is incentivizing the borrower to take that 5.25 to 5.75, which means what they were paying maybe a few months ago for those rates, they can now pay that same amount of money and get a lower rate, because then you can shift down and say, okay, all this money is flowing into the 5% coupon. Eventually, the analogy I use, it's like there's, those water buckets that kind of like, if they fill up, then they tip over and fill the one below them. That's kind of what this is like. So the higher coupons, as they fill up, as more and more investors are buying into that coupon, there's a lot of excess liquidity, and eventually investors are like, look, I'm paying too much of a premium for 5%. I'd rather pay less and get less interest. So it starts to mathematically net out roughly the same, because they're spending less of their capital, but they're getting 0.5% less interest. So then that bucket starts to fill up and it pours over, and eventually liquidity starts to flow into the lower coupon. 4.5% starts to become attractive. There's more and more liquidity there, more and more investors buying there. So now all of a sudden 4.75 up to 5.125 starts to become less expensive. And that trend continues, especially when we enter various stages of a market cycle where there's very large, significant bond rallies. And that's what we're on the cusp of. So it looks to be that inflation could be behind us. I know it's hard to believe, but this is all a rate of change data set. So although it's 9%, it's also comparing at a point where maybe the data was lower. Overall, it seems like things are peaking. There's various indicators, especially on the month-to-month rate of change, where inflation is kind of at least, not getting worse. In addition, which we're going to talk about here in a hot minute, we had on Thursday the real GDP, or at least the advanced GDP number. It's the first report. There's a couple of them before they kind of settle on a final number. But that first report was negative 0.9, 0.9%. The first quarter of this year in real terms was negative 1.6. So that's 2 consecutive quarters of negative GDP, which everyone wants to split hairs over this right now. I don't know why. It's very politically motivated, but by definition, that's recession. So the market is always a step ahead. Also debatable, but generally the market is efficient. So they're sniffing out these arbitrage opportunities or where they think things are going. And ultimately, it looks like, hey, this inflation scare is behind us. The economy is actually slowing. The Fed is, at least beating the drum that they can beat and raising the overnight lending rate and talking about, slowing growth and curbing inflation and fulfilling their mandate of price stability. So investors are seeing this, and we have a lot of other forward-leading indicators, things that show what's going on in the manufacturing sector. There's other data sets on how the consumer is behaving that show that we're actually very rapidly contracting as an economy. And in those environments, negative growth environments, negative sentiment environments, just general market uncertainty, investors want to be holding or investing in bonds because during that time of uncertainty, you have the comfort of fixed income. That bond is going to be paying you that interest rate and that cash flow no matter what is going on. You don't have that volatility that you have to worry about in the stock market of making returns based on price going up. So we're kind of getting into a place now where, a month ago, we saw the 10-year Treasury Bond peak at 3.5%. This week, it was in the 2.6 range. So that's a giant move. That's almost 100 basis points, almost a full percent move on the 10-year Treasury Bond, which acts as a very clear barometer for mortgage rates. If you look at the 10-year Treasury yield and compare it to 30-year fixed mortgage rates, even though it's, like I said, a somewhat erroneous average data set, you can see how close they mimic each other. So the fact that the bond market overall, particularly the 10-year Treasury bond, has been declining so rapidly over the past month or so, mortgage bonds have also been following suit. And this is because investors want to be in fixed income because of the uncertain outlook on the horizon. Well, this shift of capital, what we call risk off, investors are in a less risky state of mind. This flow of capital into the bond market is pushing bond prices up. And it's, as a result, making lower interest rates on mortgages less expensive for borrowers. And when I use that bucket filling up and pouring into the lower one, well, that starts to gain momentum. And we start to see what's called a snowball rally where, more and more people are like, well, okay, the 5% is now not something I want to own because it's too expensive. Well, I better, chase that lower coupon, and because that way I get a 4.5% at a decent price. Well, that's already getting too expensive. So, I'm going to put my money in the 4% coupon because I'm speculating that that's where all the liquidity is going to go in a month. And at least I can sell that bond for a profit when everybody wants to own it. And so you start to see this race to the bottom in terms of getting those lower bond coupons at a discount so that you could sell them at a premium later. And the more and more liquidity it starts to go through this, spilling over bucket effect, and the more and more lower coupons become attractive to bond investors. and more liquidity flows into them, then you get to a point where things like the 3.5% bond coupon are trading. Now suddenly 3.75 up to 4.125 is way less expensive compared to where it is today. And so what I'm trying to illustrate for you, the concept I'm trying to paint, is that mortgage rates aren't really going up or down. Whatever interest rate you think you want or think is the best option is available. It's there. You just have to be willing to pay for it. And so the goal here is to kind of time these bond market rallies so that you're not overpaying for an interest rate that a little bit down the road can become less expensive, where you could refinance into that rate and pay far less or hardly pay anything at all. So these interest rates are always there for you. It's almost like a silent negotiation. As long as you're willing to pay the fees that the market is asking and putting on public display with, what the bond coupons are trading at, well, you should be able to get an interest rate that fits into one of those buckets. So interest rates are not necessarily going up or down. The price in which you have to pay for a lower rate, for example, is becoming more or less expensive. So look, it's tricky to kind of explain this in audio format without visuals. But hopefully that's at least got you scratching your head and sound new enough and maybe complicated and sophisticated enough that it's changed your perspective, or at least is going to lead you to look into this a little deeper. Because I'll be honest, one of the things that just drives me crazy, and I post about this a lot lately on social media, is this idea that Fed raising rates means mortgage rates is going to go up. And when the Fed starts cutting rates, it means mortgage rates are going down. And it really tends to be the opposite effect, because as the Fed is raising rates, it's part of this tightening cycle, as we like to call it, meaning the monetary policies that they're enacting are growth restrictive because, they're raising rates. And again, I've already beat that to a dead horse, that it's, really just an overnight lending rate, and the markets kind of sniff out the Fed's decisions well in advance and kind of move the market on their own. But still, as a narrative goes, monetary policy is tightening, the economy is contracting. We can now see that with 2 quarters of data. And so as a result, we start to get this shift in sentiment, and investors start to move more money into the bond market. And although the Fed is raising rates, what we're actually seeing in mortgage rates, because it's tied to the bond market, is that they're going down. And now is such a great time to bring this up and talk about it, because the Fed is aggressively raising rates. Yet over the past month, mortgage rates have declined significantly. The U.S. Treasury bond market on the long duration end, like 10 to 30, has declined rapidly. Like I mentioned, the 10-year Treasury bond is down almost 100 basis points in about a month. That is a excellent barometer or leading indicator of where mortgage rates are, at least the path and direction and velocity. So the Fed is raising the overnight lending rate now in just 2 months, 150 basis points, or 1.5%, and mortgage rates have declined a fair bit since the peak in June, since the Fed has been enacting these tighter monetary policies. So as strange as it may sound, as much as what you think you believe to be true, the data is there to kind of support what I'm explaining. But this ultimately, whether you like hearing it or not, this is actually how it functions. So once you kind of get your head around it, you can start making decisions around how to structure your mortgage more strategically, which we will definitely get into in a very near conversation. But to try to keep this somewhat tight, and your eyes might be glossing over after this somewhat complex conversation about mortgage bonds, I do want to at least dip my toes into the GDP print. I did mention it, so we don't have to talk about it too much, other than the fact that 2 consecutive quarters of negative growth is typically seen as a recession. There's a lot of hair splitting going on about this. The current administration is trying to, earlier in the week, get ahead of the data that they clearly knew was coming, and more or less say, well, no, that's not what the definition of a recession is. I don't really care if you want to call it a recession or not. We have 2 quarters of negative real growth. We have a plethora of other economic indicators that show the economy and aspects of the labor market are not growing anymore. We're seeing an increase in jobless claims. And again, remember, the Fed is now trying to do this tightrope where, well, hey, we've got the employment thing sorted out. Unemployment's at record lows. So let's be really aggressive with our rate policies so that we can stamp out inflation. But now, as a result of that, whether it's the Fed doing or just the market doing its own tightening and its own response to what's going on in the economy, including the global economy, whoever's responsible for this slowdown, whoever's responsible for the response to the inflation data is not necessarily the point. The reality is it's happening. We're going through it. And whether you call it a recession or not, the fact is the economy is slowing, and the thing to keep a close pulse on is employment. Because as the economy slows, businesses spend less, consumers spend less, you get into a negative feedback loop. Eventually businesses aren't making as much. They start laying off workers. That, adds to the momentum of this negative feedback loop. So the Fed at this point still feels confident in being aggressive with their monetary policy as long as employment is stable. And I think that's the real thing now to look at, because we've had 2 consecutive quarters of GDP. Whether you want to call it a recession or not, it's a trend. And if that trend continues, with which the forward-looking data suggests it's going to most likely be slow or negative again in Q3, even though we're just at the beginning of it, this is a trend that if continues, we've got to be really careful about what happens in the labor market, because that's when a recession really can stamp its name on things and say, hey, I am here. This is the real deal. And that's when recessions can spiral out of control. Then you potentially have a housing bubble that can burst, and the housing market is one that people are also watching very carefully, because home affordability has been a big problem. And I think for a very long time, at least for the last couple years, consumers could spend on credit cards, then refinance that debt across 30 years in a cash out mortgage refinance. And every time they did that, the 30-year rate was lower and lower and lower. So it was a no-brainer for them to continually just finance a lifestyle. Now, I think a lot of people have their back against the wall. They're maxing out on credit cards. Things are more expensive. Maybe even their employment is in jeopardy. And this can get ugly pretty quickly. So the best thing we can do right now is to stay liquid. And this is one of the reasons why cash flow is so important. This is one of the reasons that there's not a lot of speculation going on. And keep a close eye on the economic data, because employment is one of those dominoes that if it falls, you can't just pick it up off its feet or tighten it up and get it under control like you can with inflation with, a couple rate hikes. So look, that's where we're at right now. I think I left you with a lot to ponder and think about. It's going to be a very interesting second half of the year, as I've been saying, but now some of these trends are really digging in their heels. And I think at some point, overall, the one big takeaway when we look at the negative growth trend, what the bond market is doing, how interest rates are coming down, is at some point here, maybe much sooner than later, the way the market's pricing it with Fed futures is the Fed might be pausing or even pivoting and eventually cutting rates as soon as the first quarter of next year. I mean, that's looking into a crystal ball. We don't really know, but that's how the market's pricing things. And in a lot of ways, the tail wags the dog, and the Fed is very reactive, not proactive. So if the market's telling us this is probably when things are going to be ugly, or that the Fed is on track to probably screw something up, and this is when they're going to have to shift gears and shift their plan, that's something to already be planning for, because that's less than 6 months away. And that can come very, very quickly. And you don't want to be making decisions, at least in the context of mortgages and mortgage refinancing and interest rates. You don't want to be making those decisions today without a concept of what's potentially coming on the horizon. So we'll get into more of that later. We'll talk about how to do a strategic refinance, considering some of these potential things on the horizon in a very near podcast episode, maybe the next one coming up. That's if we don't have any more fireworks like we did this week. So definitely a very interesting week. We had the Fed funds overnight lending rate. The Fed policy decision was to increase that by 75 basis points. Then we had a negative 0.9 Q2 GDP print. That's 2 consecutive quarters, more or less the official definition of a recession, whether you want to call it that or not. It's now a trend. And so that's where we're going to end off the week. It was quite an interesting one. Overall, I think this is, the beginning of a very noteworthy bond rally, which means I think we're going to see much lower mortgage rates over the back half of this year. So stay tuned for that, and stay tuned next week for another episode of the Mortgage Guru podcast.